I will keep my video off. That will increase the bandwidth for all of y'all. In case you want, let me know. I can then start the video again. Okay? Yeah. Okay. So this, as you know, is a course on financial risk management. So what I'm going to talk about first is about risk management and the whole argument about financial risk management. And then subsequently from tomorrow, we will move into how do you do it, which is where the derivatives and those arguments come into picture. So I start off with the basic argument of introduction to risk management. I have already uploaded this material, so all of you do have access to this slide or this set of slides. So the first question that we need to answer, or we need to ask, I don't think we will have an answer, but the first question that we ask is, what is risk? And in some sense, risk is defined as nothing but a deviation from the expected outcome. It could be deviation in any aspect of business. It could be any deviation in any form or as is kind of risk. So whatever is the deviation, what do I mean by this deviation and from the expected? So let's say you invest $100 in a stock. Let's say you invest $100 with Vietnam Airlines for a period of, let's say, 1 year. At the end of the year, you would want this $100 to grow to some level. You would want this $100 to go up somewhere. Let's say you expect the $100 to become the value of this stock of $100 today to become $120, which means you want a 20% return. That is what your expectation is. However, if the value is not realized, that will not be a good idea, that will be a bad outcome for you. And that is what, but the thing is, today you expect it to go to 120, however, it may or may not go to 120. The deviation or the fact that it may not go to 120, the difference of 120 is what is the possibility, is what risk is. So risk is the possibility that it will not become 120, it will be different from the expectation of 120. Now you realize risk can be on two sides. We are going to be concerned about only one side of the risk, which is the adverse impact of the outcome. So when we will actually have a problem. Because take our example, I invested $100, I expected it to become $120. In reality, two possibilities can happen. The amount goes up and becomes $150, or it does not go up to 120, it is only $102. Now, if it becomes $150, it is a risk, it is a positive risk, because it has beaten the expectation of what you had. However, it is a favorable outcome for you. You would have been happy with $120, you are now earning $150, and hence, that is a better outcome for you than getting only $120. You would have been just about satisfied at 120, but the moment you get 150, you are happier. And hence, that is a favorable or a positive outcome for you we are not really worried from a risk perspective. We are not really worried about that side of the story. In fact, we would be happy if that kind of happens. However, the other side of the story is also there, which is if it does not go up to $120, it only goes up to $102. So you expected the price to go up to $120. You are only make so basically you expected to make a profit of $20. You are making a profit. Oh God, voice is cracking. I just don't know what to do with it. But my internet is kind of in the full thing. Phone to use my phone as a mic. Let me try to see how do I do that. Okay, let me just try to see that. Okay, can you 1 second? I will have echo on this. 1 minute. I will have to switch this off. Okay, is this better? I'm using my phone. Is this better?
Yes, it's better now, Professor.
Okay, so I'll use this. No problem. So thanks. I'm going to have the screen on for the PowerPoint, and I'm going to use the phone to kind of speak. So hopefully this is going to work better.
Yes, thank you so much.
Okay. So okay, let me start from where I was. I will go back and then start from the problem now is how do I change slides? Okay, I'm going to have to do that. Okay. I cannot change from here. Okay. So as I was saying, what is risk? Risk is defined as a deviation from what we expect. And the example that I was giving you was the fact that I have invested $100 in
Vietnam Airlines for a year, and at the end of the year, I expect that value to be $120. Now, that means I'm expecting a return of $20. I do not know what the actual outcome will be after a year. So let's assume that after a year, there are two possibilities. The outcome becomes $150 or becomes $102. Let's look at the $150 side first. So you were expecting and you were satisfied with a profit of $20. You have now got a
Professor Basu, are you here?
Yeah. I just got disconnected. Because of these
Okay.
two devices, I got disconnected, but I think I'm back now. Because I'm using two devices simultaneously. I have a screen on which I have my presentation, and I have my phone from which I'm speaking. I don't know why this is happening, because I use the same setup for all my Zoom calls and everything, and I don't really get an issue. But today it seems to be some bad day. I don't know. Anyway, let me carry on. I hope this will work. So as I was saying, I have $50 of profit against an expected profit of $20. So if my expected profit is $20 and I make $50, I'm very happy about it. I don't really have a problem. But on the other hand, when the expectation was $50 and I only made $2, price went to $102 or the value went to $102, I am short by $18. That is an unfavorable situation to me. So what ideally, the risk is on both sides. It goes up beyond my expectation, it goes below my expectation, both are risks. But for all practical purposes, I will actually look at the adverse outcome. What do I mean by adverse? Outcomes which are not favorable to me, and that is what we are looking as the price or as the risk. The other thing that you have to understand is that risk is something which is not bound to happen, and therefore it is not necessary that because there is a risk you will lose. You have a possibility of a loss. So another way of looking at this is, if the risk is realized, you'll end up having a loss. Risk is nothing but realized loss, because if it is risky, you may lose, but it is, as I said, it is not guaranteed that you are going to lose. However, if it's a loss, you cannot unwind yourself, you cannot correct yourself. You may so if you've lost money, you may say, I will restart business by putting in more money and by starting the process once again. But the original process is over. You cannot continue with the original process. And that is what I mean by saying that risk, but that risk is not guaranteed loss. Risk is an expectation of a loss. A loss may happen, and that is why what you are doing today is to kind of correct yourself or cover yourself against the possibility of a future loss. It is something which will only always happen in the future. It can never happen in the past. Based on your past data, you can kind of say that this is what can happen, but it is not something that will ever happen in the past. It will only happen in the future. The second point is that It is something that you cannot do without. It is present everywhere. Whatever you do, whatever you say, there is risk in everything, every aspect of our life. And we cannot do without risk. So, to that extent, risk is something which is omnipresent per se, and you cannot do anything without it. However, what can you do? You can significantly impact, you can kind of try to utilize the risk for your benefit. So you can try to kind of play around with the risk to leverage it. What is leverage? So investing with borrowed money is, for example, leverage. Because what happens? When you borrow money to invest, you are required to pay back a certain amount, a fixed amount, which is the amount you borrowed and the interest cost on that. If you make more profits, the additional profits are yours. If you make losses, and if there are huge losses, the additional loss, you will only, you might at best become bankrupt. And if you become bankrupt, what do you lose? You lose, or how much do you afford to lose? You lose the amount of money that you have borrowed or that you have invested. You do not lose anything more. So, but if there is a bankruptcy arising out of a borrowing that you have done, the additional loss will have to be borne by the lender. And that is what leverage kind of brings you. It allows you to kind of invest with lenders' money and allows you to kind of take the upside, which is the additional benefit, but the downside is limited to the amount that you have borrowed and you have committed to repay. So you are basically taking risk. You're taking it, I mean, in a sense, you're investing, you're making risky investments, but the loss is not on your own amount. Because if you lose, you just lose whatever the agreement to repay was, and then whatever default conditions happen, but not on additional cost on yourself. And that is what the leveraging effect is. That is what you can do with risk also. And therefore, if you look at this is what happens. It is an event, and if I put all of this together, this is what the definition would be. It is an event which is likely to occur. It has obviously not occurred, because if it has occurred, then then the risk is translated into a loss. You are saying there is a possibility of a loss, but it is not a loss as yet. So it is an event which is likely to occur. The event can potentially have adverse impact or consequence. So it is possible that this event can lead to a loss, but it is not guaranteed. It is potentially an adverse impact on what? On the planned outcomes, events on the planned expected results of an event, a proposal, a project, a business decision, whatever the case may be. This is a possible outcome that can happen in the future and can have a negative impact on that. In most cases, it is a result of unintended outcomes of perfectly well-reasoned decisions. What do I mean by that? You do not invest money in assets, or you do not put money where you know you are bound to lose money. If you knew you would lose money with certainty, you would not invest in such assets. So you are expecting not to lose money. So I mean, in a sense, you would, or put it the other way around, there is no rationale for you to invest in an asset where you know it will not give you money. In fact, you will lose money. So when you are making the investment, you are making the investment with all good intent that the money will actually come back to you. You are making a sound decision, and you will kind of earn money and then make profits out of it. However, what can happen in practice is that even though you've made the best of decisions, you've made all the correct analysis and choices and all that, yet other conditions, other issues happen which cause the markets to move, or which cause the process to move in such a manner that you suffer an unintended loss, that you are exposed to a loss, even though you did not want to lose, even though you thought you will make a profit, and with all your best intent, you actually end up making a loss. And that is not because you have done anything wrong, but because some other things have happened in the market, which has caused the loss to happen. And this is essentially a very inherent argument of risk, because if it is risk, if it was a guaranteed loss, you would not have invested in there. You have done all this analysis to understand that this will no, I mean, based on the assumptions that you have, you know that it will, you are reasonably certain that you will not suffer a loss. Yet if there is something that has happened which is beyond what you've assumed or beyond what you've controlled for, that can still lead to a loss. Now, initially, it is very difficult to quantitatively assign and quantitatively assess this amount. So, in the normal conditions, initially, people do some subjective analysis of this. So, I will have a discussion with you to understand what kind of position you're taking, what kind of basis do you have, and then kind of have an idea about what kind of losses can I be exposed to. As things go forward, I can kind of try to get more objective data to see how better I can estimate that and what else can be done. But in the initial phase, it is most of the times you would actually look at some initial discussion, some dialogue to kind of see if you can kind of get for you to kind of get some idea about what kind of numbers, what kind of risks are you exposed to, and check based on that. Now, why do you want to do risk management? What is the rationale for you to do risk management? This is some of the rationale for you to do risk management. Potential business threat. You are doing the risk management because you have a problem. After all, your investment is a business that you are engaging in, is an activity of yours. A business engages in various activities. And if you do not manage your risks, what can happen is that the losses can suddenly come and hit you. The risk can suddenly manifest itself in the form of losses. And if it does, then the losses can actually be very large. And you can kind of be thrown out of business also. So it is essentially a whole argument of a potential business threat that you might have, and hence you might, and that is your primary reason to cover to kind of engage in risk management, so that your losses, you are kind of safe. You are not exposed. You are okay. When I say you are safe, you will never be 100% safe. You are as safe as you can possibly be, subject to the amount of risk cover that you have taken, and therefore, in a sense, ensure the fact that you can potentially continue in business, even though you might, even though there are other factors, there are potential loss factors that can kind of happen. What are some of the other reasons as to why you might want to do risk management? Well, you want to do business with somebody. Your counterparty requires you to kind of follow certain norms, which also include certain norms with regard to risk management, for you to do business with that counterparty. So you need to be certified, you need to be having some processes in place. And therefore, for you, if you now need to carry on or continue with business, you would actually have to manage the risk, and hence you will actually have to kind of engage in risk management per se. Also, another rationale for you to do that is to kind of use risk management as a tool for improving business. Using risk management as a tool to enhance business growth and its competitiveness. So you want it to be a tool for better business outcomes and a more competitive outcome in that context that you have. Now you all know, and this is something you all have done many times, and I'm sure in earlier courses, this whole argument of risk versus return. What does it mean? What it means is that, as we know, risk and return are directly proportional to each other. In other words, higher the risk, higher is the expected return. But there is one small flaw or a you know a kind of a subtlety in this statement. Yes, higher is the risk. Sorry, higher the risk, higher is the return. But the return could be both positive or negative. Obviously, you would want it to be a high positive return, but you could also land up with a high negative return. And what is a what is a negative return? Negative return is nothing but losses. So, in as much as if you take high risks, in as much as you can make high profits, you can make very high losses also. And that is what the problem is. So, for example, let's say there is a lottery ticket. You may have to buy the lottery ticket at, let's say, $1 million. But if you win the lottery, you may make a profit of, let's say, $500 million. Right? Now, now building on the now if I want to kind of keep that argument, so now if I have a very high loss, negative profit is or negative return is nothing but loss. So if I take a very high risk, I might also be exposed to very high losses. So it's like all or none kind of a scenario. As I said, the example that I was using, you buy a lottery ticket for, let's say, $100,000, not a million, let's bring it down, for $100,000, and the first prize, the winning prize, is $1 billion. The loss, or if you do not win the prize, you will kind of not earn anything, and you will not even get your $100,000 back. So realize your return, your risk is very high, because you could earn $1 billion or you could lose everything. So against $100,000, the lottery could get you $1 billion, good return, but high risk, high risk and high process. On the other hand, you might lose, and if you lose, you lose the entire amount, which is the entire $100,000. So therefore, a high risk and a high risk will give you high returns, which could be both positive or negative. So let's look at this as an example. If you look at this as an example, what do I have? I have given you a data where I am telling you that there are treasury yields. The treasury bond, the government security, the treasury gives you a 5% return. You have a sum of money which you can invest in treasury, or you can invest in equity, you can invest in the market, and the return, if you invest in the market, these are the returns that you can earn with these probabilities. So you can earn a return of 50% with a 5% probability, 30% with 25% probability, 40% with 10% probability, but you could lose 10% with 25% probability, and 30% with lose 30% with a 5% probability. Yes, fam.
No, actually, no worry. Just keep going.
Okay, because you were typing, so I thought you wanted to ask something. It's okay. Sorry. Now, which investment would you do? Would you invest in the government security at 5%? Would you invest in this equity investment with this kind of returns? Well, let's first find out what the expected return on the equity is. So I can find out that if you take the expected return, what do I do? Let me make this large. You see, what you do is you multiply 0.05 with 50% plus 25.25. So 0.05 into 50%, which is 0.05 So you multiply 0.05 into 50%, 0.25 into 30%, 0.4 into 10%, 0.25 into minus 10%, 0.05 into minus 30%, add them up, and what you land up getting is an expected return of 10%, and you can also calculate the standard deviation of this, and you find out the standard, and you find that the standard deviation of this portfolio works out to be 18.97 and 19%. Your alternate investment is at 5% return from government securities, but they are secure. You are on all scenarios, you are going to get 5%. So there is no possibility of you not getting the 5%. And therefore, which one do you take? I don't know what is happening out here. Well, I hope this is not showing up like this on your slides, which I had shared with you all. What this should read is that you have sigma P, W1. So what is my return? My return on the portfolio is W1 into sigma into mu1. Mu1 is portfolio 1, mu2 is portfolio 2, and W2. So how much money can I invest in each one of them? And if I honestly don't know what is this thing going on. And your sigma, and the right hand side is sigma P, which is equal to nothing but square root of W1 square, sigma 1 square, which is the volatility of the, or the standard variance of the portfolio 1. Then you have W2 square, W1 and W2 are weights, variance of the second portfolio, and then twice W1, W2, rho, which is the correlation between the two portfolios, sigma 1, sigma 2. Now I can put different weights under different, so I have W1, my portfolio 1 is 10%, portfolio 2, let's say, is 15% return, sigma 1 is 16%, sigma 2 is 24%, and the correlation between the two portfolios is 2%, 0.2. If I solve that, if I put that, and if I look at it for different values, and I look at what the portfolio function will look like, that will kind of give me this kind of curve, which is what is otherwise known as the efficient frontier. And this is something that you all have done earlier. This is what the efficient frontier is, because what you can then see is that your return, if I put W1 and different values of W1 and W2, you will, so in this side, I am putting everything in W2. Here I am putting everything in W1. And these are different choices of W1 and W2. You will get this kind of a curve that will show up in the process. And that is what is kind of referred to as the efficient frontier. What we would want to do is we would want to be on this efficient frontier, because that is that kind of leads me to the best possible scenario under the given choices, under the choices that I have. So if I, for example, if I go back out here, you will realize that this lower half of the curve is something which you would not want to use, because for this period, you see, for this point, you have a risk which is, let's say, 16%. Your return is 10%. But for the same 16%, if I go up here, I get a return which is, let's say, 12%. Now, a 12% return is obviously better than a 8% or a 10% return, and hence I will always choose that point, because my risk is not changing. So this lower half does not make sense, as this only the top half that kind of makes sense. And that is what I kind of draw out here. If you look at it, I only look at the top half of the graph, and I do not bother about the lower half of the graph, because that will essentially be replicated by a better point on the top half of the graph. So I would ideally want to be on the efficient frontier. I would always want to be on the efficient frontier, because that is the most efficient investment that I can do. And if I now plot the efficient, if I now add a risk-free, so what have I done out here? I've also added an investment of a risk-free return. So investment in government securities. which guarantees me a certain amount of return that I will get. So what should I do? If the return is on this side, my optimal return point should be the point at which the tangent from the risk-free rate to this efficient frontier, that should be my optimal return thing. So that should then become my new efficient frontier, because along that route I am going to earn my constant R, and if you see, that is essentially better than what I get on this graph. So if you look at it on this part, this part is obviously better, the return is better than the corresponding curve out here. So up to point M, that is what, so and if you look at it and all through, this is the point where it is equal. Everywhere else, this is a better choice, and therefore this becomes my new expected new efficient frontier in the story that I will kind of create. Now what happens again, this is weird. See, what we try to do is we kind of try to write down the relationship between the risk and the return from the investment and return from the market. So RM is the return from the market, RA is the return from the investment. What we argue out here, and I know this is very difficult and very stupid to read it in this form, but what we are trying to say is that the market return is going to be combination of two things. One, which is, the market effect. So I'll come back here. One, which is the market effect, and the other, which is a unique element effect of the asset in which you're investing. What you can do is you can start diversifying. So the example is like this: you put all your money in one stock, you put all your money in Vietnam Airways. Now, if the airline stock does badly, Vietnam Airways does badly, you suffer a loss. On the other hand, let's say you put some money in Vietnam Airlines, you put some money in some bank, you put some money in some other some rubber company, you put some money in some coffee plantations, coffee companies, and all that. Chances are that all of them doing badly uniformly is very low, and hence, even if one asset does badly, the other assets may kind of still do well, and you get a portfolio return which is acceptable. But what have you done in the process? You have diversified your risk. So you have a diversified risk. The diversification of risk or diversification of the portfolio does lead to a reduced risk. But a reduced risk also implies that it also means a reduced return. So therefore, there's always this question that you need to ask yourself and be ready to answer. It's how much of a risk are you ready to diversify, and therefore how much of a return are you ready to sacrifice. Now the problem that you will have is, even if I were to diversify, even if I were to agree to diversify all my risk, 100% of my risk, in practice or even in theory, I will not be able to diversify 100% of the risk. There is some part of the risk which I will not be able to diversify. That is what is called as the systemic risk that I have. This is what is non-diversifiable. Another way of defining systemic risk is, this is the risk of the market itself surviving, and hence you can be able to continue to do business. So and the other side is the unique risk, which is the unique company where you've invested in, the risk of that company surviving. Now the company may or may not survive. The possibility of the market surviving is much higher. So but you cannot do any. But in the event the market does not survive, you cannot do anything, and you would essentially lose in that story when the market kind of loses, when you lose in the market, when the entire market collapses. If the market but the market can continue to survive, yet you can kind of lose because your individual portfolio is suffering a loss, not the market. Now this is what is called as the capital asset pricing model. And this is exactly what we were doing in the last slide. So let me just kind of, okay, what is the equation? Let me write down, let me show you the equation, and then we will look at it. So the expected value of R of any asset, expected value of the return on any asset is RF. RF is the risk-free asset, risk-free rate, plus, which is missing out here. So this is expected value of R is equal to RF plus beta. Beta is the measure of sensitivity between the market, between the asset and the market. So beta, which is how synchronized is the asset with the market, and this is what, this is the expected value of RM minus the risk-free rate. So this is the excess return of the market with respect to the risk-free rate. So if I, by going in the market, how much of an additional return can I earn with respect to the market? So my return on a given asset is the risk-free return plus beta, which is nothing but the measure of sensitivity of the asset with respect to the market, beta times the excess return the market gives you in the over and above the risk-free rate. So essentially that is the cost, or that is the return that you earn for the additional risk that you take. Remember, by definition, when I say it's a risk-free rate, there is no risk, so you will not, there is nothing for you to, under no scenario will you lose that money. However, the return on that will actually be low, and therefore you will, the market will kind of give you an excess return. Now there are some assumptions that kind of govern this, and the assumptions that govern this are this: that investors and all of us only care about expected return and the standard deviation. SD is the standard deviation. The standard deviation of the return. We are not, we are really not worried about anything else. As an investor, I want to know how much will be my expected return and what will be the standard deviation of the returns. The ease out here are the expectations of different investments are independent of each other. So when you put money in Vietnam Airlines, when you put money in a coffee company, when you put money in a rubber company, the expected returns that you expect to make from each one of this are kind of independent of each other. Also, investors will typically focus over a 1 period horizon. The 1 period could be 1 day, could be 1 year, could be 1 month, whatever. But whatever I define as 1 period, investors typically we are concerned about a 1 period assumption, 1 period for return. Now this can be questioned. This is an assumption that here is taken, but in practice you can kind of question this, because you can have a scenario where people are investing for a much longer period. People are investing for, let's say, 5-year horizon. So you might actually have 5 period, and then the period is 1 year. So you might actually have a 5 period return also. But here the assumptions are that investors will only have a 1 period focus. Another simple market condition that we have put in, that the assumptions put in, is that all investors can borrow and lend at the same rate, and that is the risk-free rate. So everybody has access to the same risk-free rate, and all borrowing and lending happens at the same rate. This is a very, very hypothetical assumption, because in practice this will never happen. In practice, the borrowing rate will always be more than the lending rate. So the rate at which banks will borrow will be the rate at which they will borrow will essentially be will be more than the rate at which they can lend. From the bank's perspective, the rate at which the banks will borrow will be less than the rate at which the banks will lend. And what is the borrowing for a bank? Your deposit in the bank is a borrowing for the bank. The money you put in the bank is what the bank is borrowing from, is the rate at which bank is borrowing from you. The rate at which you borrow from the bank is the rate at which the bank is lending to you. So in the context of the bank, the borrowing rate will be lower than the lending rate, and that is why the bank will make money or make profits. You, on the other hand, will typically borrow at a more expensive rate, lend at a cheaper rate, and therefore you will lose money in the process. For simplicity and here we assume that the borrowing and the lending rate is the same, and it is essentially the risk-free rate. which means there is no additional money to be made by looking at a borrowing and a lending argument per se, by simply borrowing and lending parallelly. Tax has no impact, again something which is very artificial, because obviously we know in practice taxes do make an impact. Taxes do have an impact in terms of the investment decision. So if there was some product where you could invest and the investment was there was a different tax level as opposed to investment in some other category. So there are two categories of assets in which you can invest, A and B. In one category you pay a tax of 20%. Category A, you pay a tax of 20%. Category B, you pay a tax of 5%. Everything else being the same, you would always invest in asset B, because you have to pay only a tax of 5% as opposed to as opposed to 20%. So therefore, that's something that will kind of in practice will always happen. But here we are basically implying there are no taxes, or even if there are taxes, everybody is exposed to the same tax level uniformly. So there is really nothing different that right? So that's what it will kind of so that is what it is. Also, investors make the same estimates of the mean, the standard deviations, and the returns. So all investors make the same. So basically, there are different estimates. There are different parameters: the mean returns, the standard deviations, and the expected returns. For the same asset, everybody has the same return. For the same asset, everybody will have the same return, and that is what the assumption out here is. What you can also do, I will write this down on a Word file, and I will try to, or I will create a PDF file with the correct estimate things, and I will try to, and I'll send it back to you all. But for the time being, let me just continue with this. Alpha is a measure that measures the excess return on a portfolio in excess of that which is predicted by the previous thing, which is the CAPM. What is CAPM? CAPM, CAPM stands for Capital Asset Pricing Model. So the capital asset pricing model predicts a certain return. Alpha is the measure of the excess return. So how much is the actual return in the market? How much was the return that was predicted by the CAPM or the CAPM model? That excess return is what is defined as alpha. So, or sometimes is also referred to as the Jensen's alpha. So, if I have the CAPM equation, alpha is nothing but RP minus the CAPM equation that I have. And that is the excess return that it is kind of giving me. That is the excess return that it is showing up in that process. Yes, Matthias. Yeah, Matthias, what's your question? I know you can't see the symbols on the formula. I don't know what has happened because I mean on my PowerPoint it is there. When I uploaded it onto your canvas, this is what happened. That is what I said. I will convert this into a PDF file where the formula will be exactly seen, and I will email it to Lynn tonight, so that you can actually have a hard copy which will have all the formula in that specifically written. Okay. I'm really sorry about this, but I don't know what has happened because when I open it on my PDF, when I open it as a PowerPoint, it still shows. It is something in the conversion and the uploading onto Canvas that this is kind of happening.
I think.
Yes, ma'am.
Yeah, I think this is the problem with BBB, because last time when I do my presentation and I upload the slide to BBB, then it will have some kind of font issue. But if you share your screen, then I think
I can share my screen.
Yeah, I think if you use the mode that you share your screen, then you show the presentation, then it might not have this issue. You can try later on.
Okay, maybe after the break, when we start again, we'll try what you're talking about. You can help me with that if that's okay with you. Okay.
Yes, sure. Thank you.
But as somebody tells me that if you look at the uploaded file in Canvas, you can see the formula explicitly there. The slides are exactly the same. So the formula is there in the uploaded file that I've already sent. Okay. Well, there is also this argument of arbitrage. What is arbitrage? Anybody? Any idea what is an arbitrage? Anybody? What is an arbitrage? Not a price difference, yes, but not entirely a price difference. I mean, obviously price difference, but there is something more to it, and that is where this argument comes in here. It is what is called as a riskless profit. So price difference under a riskless environment. If I buy today so now if I take an example, if I buy a stock at $50 today and I sell it after a month, the price can go up from 50 and I can make a profit. The price could come down from 50 and I could make a loss. So the idea is to ensure that so that is not an arbitrage, because I can also make a loss. Arbitrage is when I make a profit because of a price difference under all circumstances, irrespective of whether the asset price goes up or the asset price goes down. So one example of an arbitrage is something like this. Let's say you buy it right now and you parallelly sell the asset to somebody else. Obviously, the person from whom you are buying and the person to whom you are selling don't know each other. So what you can do is you are able to buy it at a slightly cheaper price, and you are also parallelly selling it at a slightly more expensive price. You are not holding the asset. That way, what happens? Now, if the price goes up, you buy at a higher price, but you also sell at a higher price. Price goes down, you buy cheaper, but you sell at a price more than the price at which you bought, but at a cheaper price. So irrespective of whether the price goes up or the price goes down, you make a profit. And that kind of a profit is what is defined as an arbitrage. Arbitrage is the one word definition or the one sentence definition of arbitrage is that it is a riskless profit. It's what is called as a riskless profit. Right? Now, you can also use arbitrage, and because it's out in that context, to kind of define risk in some sense. Risk can be expanded to define, so it is basically, the returns are obviously dependent on a number of factors. What you can do is you can create portfolios to kind of take out the dependence of these factors. So you can kind of create portfolios which will ensure that certain other factors, the factors are kind of taken away, or the impact of the factors are taken away from through the creation of the portfolio. And that leads to the result that then your expected return is nothing but a linear function of all these factors, linearly dependent on the realization of these factors. So you can then write it down in the sense that, and that is what your arbitrage pricing theory talks about, that if I and therefore the adjustment of the risk, if I can create I can create some portfolios which will eliminate the dependence of my dependence on some certain factors, and obviously that would then result in the case scenario that the expected return would be a linear. When I say linearly dependent, which means what? I can write it down in the equation of y equal to ax plus b. It is a linear relationship. It is a linear function of the realization of these factors that kind of impact the individual assets of the portfolio. And if I can do that, then I can kind of balance on the risk from there. And that is what I can kind of try to do in this process as well. Now, one I want to kind of also highlight a little bit, because there's a lot that is talked about for individuals. But I also want to highlight a little bit, which is in terms of what if it was a company? What if it was, I mean, is the company any different from an individual? Well, if individual shareholders care only about the systemic risk, should that also be true for the company's managers? Because remember, in a company, the managers of the company are running the company on behalf of the shareholders. Now, should they replicate what the shareholders also do? The shareholders, people want individual shareholders care only about systemic risk. So therefore, should the managers also care about that only? Well, in practice, what we see is that managers are worried about what I would call as the total risk. What is total risk? Total risk is systemic risk plus unsystematic risk. Or in other words, risks which can be diversified and has been diversified against risks which cannot be diversified. Right? So that is what company managers, companies would be worried about or looking at. Because for them, both earning stability, how much their earnings are and how stable their earnings are, and the survival of the company are equally important. They do not want the earnings to be like, hugely very high earnings this year, very low earnings next year. So they don't want this kind of huge fluctuation that keeps on happening. At the same time, they don't want, for them, the survival of the company is also equally important. So therefore, for them, there are twin objectives that typically come in. They are kind of the twin managerial objectives that come in, which is basically both stability of the earnings as well as survival of the firm, survival of the company. In the same way, in most markets, particularly financial markets, regulators are very interested not in individual risks, unique risks and all that, but the total risk. So for example, if I take in Vietnam, the State Bank of Vietnam would be worried about the survival of the banking system. Right? They're going to be worried about not just individual transactions, but the survival of the total banking system. And why is this? Because if you do not survive, if a firm does not survive, what happens? The firm goes into bankruptcy. And if a firm goes into bankruptcy, what will happen? If a firm goes into bankruptcy, there will be a much larger loss that will happen, because in the absence of a bankruptcy thing, there was some return that was possible. But with bankruptcy, returns become even more less likely, because remember, if something is left behind, first the creditors have to be paid, only then shareholders can get their money. So therefore, the bankruptcy can kind of be significantly adverse to the shareholders. And bankruptcy cost arguments have shown that managers act in the best interest of the shareholders when they consider total risk and not just part of the total risk. So managers are therefore would want to act in the best interest of the shareholders, and so managers act in the best interest of the shareholders by considering the total risk and not just the systematic risk, non-systematic risk, unique risk, this, that, and all that. But they just look at the total risk part of the story. Okay. Now, what are bankruptcy costs? And what do they mean by those bankruptcy costs? This is what I mean by bankruptcy costs. Lost sales. You see, if a company goes bankrupt, people are very reluctant to buy from that company. For example, if there's a car company, and cars have seen this in the US, you had General Motors, you had Chrysler, and even Ford was on the brink of bankruptcy. You had these companies become bankrupt. People are very scary. People are very kind of scared to buy subsequently from them. What after the buy if the company goes bankrupt again? And therefore, the possibility of any service or anything from the company doesn't exist, and hence, and therefore, there's a problem that might just get created. Another problem is when key employees leave. So you run a company, you have a colleague, you have a person who is most knowledgeable, and for some reason, because of disagreements and all, or because of superannuation, or because of health, that person leaves, and that can kind of become a huge corporate cost or bankruptcy cost that can kind of come in. So if the key employee leaves, you can actually have a significant loss in that story. And obviously, bankruptcy is not just an action, it is also a process. And in that process, there is huge accounting and legal costs that will come in, because there are a lot of court cases, a lot of legal cases, and all of that will have to be fought. So there is a very significantly high legal cost that kind of comes in the event of bankruptcy. So therefore, if it is seen that if you don't act in the interest, if managers do not look at total the total risk or total potential loss and only look at one side of the story, this can kind of become very, very large, and the bankruptcy cost could significantly overshadow everything else. Now, I have drawn a broad diagram, and I've kind of tried to put in some of the factors that affect risk. What can affect risk? So look at the 4 kind of cloud-like parts to see what can affect risk. If you are running a company, these are some of the things that can affect your risk. What is the investment policy? What is kind of the business strategy? What kind of strategy are you entering into? That is a significant source of your risk. And then these are in no particular order. Another source of risk could be the market, and what market alliance have you? Who are your competitors? Who are your collaborators? So if you are in the business of selling product, who are your distributors? Who are your salespeople? They can kind of affect they can make or break the success of a firm. What kind of talent do you have? In the sense, what kind of people work for you? How long do they stay? Are they retained? Do they leave very quickly? Do they leave with your information, with access to your information? And right. And what kind of attitude do they have? Are they ready to go out there, take risk, and do more business, go after people, and therefore be kind of dynamic in that sense? Or are they risk averse? Do they want to step back and see and say and be extra careful? Let others first do it, and if others have been successful, only then they come into the process. So what is it that they are kind of looking at is the question that kind of comes in. And then the other possibility is technology. And what kind of technology are you running, and what kind of risk that technology pertain? Because technology is a very interesting argument. Technology risk is something that does not affect you today. Technology risk is something that will affect you going forward at a future point in time. And why am I saying that? So think of it. Let's say you want to set up a mobile manufacturing unit. You want to set up a plant which manufactures mobiles, right? What should be the now? What is your risk from a technology perspective? Is it what should you manufacture? Should you manufacture today's technology and therefore replicate today's mobile that is available, or should you look at a futuristic design and futuristic version of the mobile phone? Right? Should you kind of look at the futuristic value of the mobile phone, a phone which will be useful after 5 years? And why am I, or 3 years? Why am I saying that? Because if you were to manufacture a mobile phone today, you would have to set up a factory. Now, factories will not come up overnight. Factories will take some time to come up. And if the factory takes, let's say, 3 years to come up, what is the likelihood that a phone that you got today will remain in live? Right? But by the time the factory comes up, it might need a newer product. The market might demand a newer product. So you have given a product which the market may not find value in, and therefore they might demand a newer product. So that is a big risk, because the problem is I will actually have to take a view today as to what will be the effective technology going forward. What will be the applicable technology, not today, not tomorrow, but at a 10-year. So that is what your technology risk is. And all of this put together are what your risk zones are and what you are exposed to. So if I were to draw this, ideally you would want to see the place where all the risks converge together is number 4. Now, ideally, as I said, you would not want, if you would ideally want to be in a zone. So as I have put out there, you do not want to be in zone 4, which is basically there is no risk because everything is kind of covered, and but the high opportunity, but it's a short-term possibility. You would want to be in zone 4 or in zone 3. Zone 2 is where 2 possibilities are there and 2 possibilities are not there. Now, if that is the case, these can potentially become high risk, but they are also high opportunity possibilities. That if you do get it correct, you will get very high returns. So they are high risk, high opportunity possibilities that kind of come in that process. And zone 1 is where the risk is the highest. Those are activities or those are approaches where you will not get into. Those are what I refer as to the no-go areas in the whole process. Now, what are some of the key drivers of growth? In a firm, what will be some of the key drivers of growth? And obviously, a firm has to be sustainable. So that's why I write it out there as growth and sustainability. You see, there are various factors which are there. What kind of decisions you take, what kind of operations process you run, what kind of technology you run, what is the market opportunity that you have. So all these are important aspects of growth and sustainability. At the same time, risk is also an equally important aspect of growth, and that is the important thing that we would like to highlight out here, which is that risk is also an equally important aspect of growth. Risk is something which is also which cannot be ignored, and for you to grow you need to take risk. The question is, how much of a risk would you take, and how much of a risk should you take is something which is not uniform, which is to be defined by you in a context which is relevant to you in that sense. So therefore, what should risk management as a function do? Risk management as a, I have written it in a different order. Risk management as a function should actually, the first thing it should do is a third bullet point. The risk management as a function should maximize shareholder value. And how should it do it? It should do it through identification, assessment, monitoring, and management of the principal risks. So what are the main risks that are there? And what the way it will do it is the primary objective of risk management should be to maximize the shareholder value through by identifying, assessing, monitoring, and managing the principal risks that exist. It should obviously lead to an optimal capital utilization. It should make sure that the capital utilization that they're having, that people have or people are using, is kind of optimal, and in that sense, they are using it in an appropriate manner. They should kind of, and then the other two are also there, which is and that is more from a firm-wide perspective, that firms should benchmark their processes to internationally accepted best practices. So it should kind of benchmark themselves to the internationally accepted best practices, and it should also ensure that these sound practices, whatever they're using, are prudential norms that they're using, is something which is used across all group entities wherever possible. Wherever possible, wherever applicable, it should be used not just across one standalone entity, but across all group entities. Because at the end of the day, the portfolio is over the entire thing. Realize it is the, what do I mean by that? So realize the thing. Let's say there is a company which is a very diversified company. So there is this company in, for example, in South Korea. There is a company called Doosan Enterprises. Doosan Enterprises runs shipbuilding companies. Doosan Enterprises runs, there's a Doosan Bank. They have stock investment firms. They have construction, Doosan Engineering, which is industrial construction. Doosan shipbuilders. So they kind of are in many aspects of business. And the idea is that the best practices that are followed for risk management and all of that should be, the basic idea should be replicated across the entire spectrum, not just on one aspect or one part of the business. So it should, if there is something good that is being followed somewhere in one part of the business, it should be something which should be replicated across the entire spectrum. Because at the end of it, while as a small investor, you might be interested in only one of the aspects, but the market per se will look at the entire thing and then will kind of try to see Doosan as a single enterprise, and then the survival of that would define the success of that enterprise. And therefore, that's what I mean by saying it should be applicable. It should be applied across all group entities if applicable. Obviously, if you are a standalone company, then you do not. Then that question does not come into picture, because obviously the standalone company, then there is only one company that you would one scenario that you would kind of have. So one of the things that this is something which you all should kind of understand and in some sense believe in, because if you don't believe in this, then you cannot do risk management. What should risk management be meaning to do? Should risk management mean that I will ensure there'll be no losses? I will kind of take out all loss positions. It will be a loss-free world. Well, that is not what risk management is. Risk management is not about being a loss-free world. Risk management is about allowing managers, allowing the people who are going to be in this business to identify systematically, and that all of those words are carefully chosen and each one has a very important meaning, to systematically identify, address, prioritize, and communicate to appropriate levels the risks that arise in the course of business, and therefore take risk mitigation actions and decisions and execute the same with a risk-aware mindset in order to continuously reduce the adverse impact of risks. So it's a very complicated statement that I am making out there. But what I'm trying to say is that what it should mean, risk management means that you should allow managers to first, in a systematic, in an organized manner, to identify, address, prioritize how important it is for risk, and let relevant people know that this risk is there and this could kind of become a large problem and at appropriate level. So that is what it should do. And then on top of that, what it should do is it should kind of take decisions which will be expected to lead to a lowering in the risk, but with what I call as a risk-aware mindset. And what is a risk-aware mindset? The risk-aware mindset is to kind of understand and believe that losses, that these strategies, these actions are being taken with the best interest in mind. What do I mean by saying the best interest in mind? What I mean by saying the best interest in mind is to say that I'm going to do this with the objective that the risk will be reduced. However, it is not that it is guaranteed that risk will be reduced, and therefore there can be some problems that can kind of crop up, and that is something which we will have to live with in that sense. And that is what is a risk-aware mindset. Just because you are doing risk management, just because you are minimizing risk, does not mean that you are getting to a framework where there will be no risk. It is just that you would have taken action to cover for known risks, and the other factors can still continue to impact, but there are other factors which could kind of impact. I'm just going to skip. Okay, I'm going to very quickly run this, because what this would mean is essentially following on from the previous slides, that this essentially means that do not treat risk as something which is untouchable or something which I don't want to even think about. Make risk an inherent part of business. Make risk as kind of something which is relevant, which is completely factored in terms of the business, and it is critical, and then treat it as a process that effective risk management is going to be critical to achieve financial soundness and profitability. Remember, at the end of the day, for a firm or for an individual, a decision is supposed to kind of take care of achieving financial soundness and profitability, and that is what risk management should be treated as. In that context, one should identify risk management, or one should treat risk management as a core competency. So you need to have risk management as one of the core strengths of your business, of your actions, and that will only make it an inherent part of the business. The goal is to understand, measure, monitor the various risks that arise. And what I mean by that is measure, monitor, and I'll talk about in the very next slide. When you measure and when you do all this, when you understand, when you measure and you monitor, you are essentially also taking action to mitigate. What action you take is something that you will actually have to think about. That's a part of your monitoring mechanism. But that is what you can do. You first identify it. You understand what is the risk and where is it coming from. You measure the risk, because sometimes the risk may not be worth spending your time. There is a small risk, but it may not be worth spending too much of your time in that context, and therefore you may not want to do something with it. Whereas in some cases the risk may actually be very, very large, and therefore while the possibility of a large risk is that is low, but that might require you to be careful, because if that happens, the loss may be very large. So obviously you measure the risk, you understand the risk, what is the implication, and then you monitor the progress, and you monitor what kind of action can you take in that. Obviously, the better you, now once you know more about risk, the more you spread the awareness about risk to all market participants, the better it is, because that way the whole market will benefit, and therefore possibilities of this kind of unfortunate risk events will actually reduce, and hence there will be a better synchronization and a lower risk in the overall scheme of things. Just to kind of give you the explanation about the last one, and in a context which is nothing to do with finance, but something which we are all stuck with, and which is why we are kind of doing the class in the way we are doing it today, is your COVID-19 story. If you think of it, if people, today there is a lot more sharing of information across countries, across organizations and all that. And that is what is helping us combat it. If that was not the case, people in one part of the world may have some information, which is exactly what happened when it started. Realize China, and even today there are questions that China knew about COVID, or the fact that COVID there was something like this that was happening, but however it might have happened, sometime in November of 2019. Yet they did not disclose it in any form, and even though subsequently when they did, the World Health Organization, WHO, did not disclose it publicly till sometime towards the middle of January or end of January 2020. And nobody really, the rest of the world did not really take it seriously in any form till about February, March of 2020. So you realize that there was a good 2-3 month window where if this was shared, where if this was known, where if people had taken it seriously, maybe we would have been better prepared. Maybe we would have addressed the problem in a slightly different manner. Because what we did was, if you go back and look into it, the crisis happened, it spread, and only once the thing spread, once it spread from China to Europe to the United States, and then subsequently to the rest of the world, we actually started really reacting. Because I remember in January 2020, around this time, actually even a little earlier, I was in Hanoi, I was in Ho Chi Minh doing the same course 2 years back. And there was, nobody was really talking about COVID, not in Vietnam, not anywhere else in the world. Yes, this was some kind of a virus that, there was a brief mention that there was some kind of this virus and a problem that had happened in China. But nobody had really spoken about the widespread impact this could have, because that information wasn't shared. And that is what I mean. So now if that information was shared, one would argue that it would have been necessarily better for everybody. And that is what in financial risk management also one argues, that you should do that, because that will ensure the market itself improving and the market doing better. This is just following on from what I have said, so I can just skip this slide. This is nothing new apart from what I have said, so one can kind of just skip it and move forward in a little more. Okay. Let me now talk about. So what I've tried to do is I've tried to put it into a table kind of a chart kind of a format, and what I call as a business of risk. Let me explain this. So I am worried about firm-wide risk, and I'm dividing my firm-wide risk into two parts. One, what I called as business risk. What is my business risk? That that I want to do business, I want to do a certain kind of business. I'll explain each one of them in a minute as I go along. But then to start off with, I want to do a business, I want to do a certain kind of business, and that is the cause of a certain kind of risk that I'm exposed to. So my business risk is the risk arising from the fact that I want to do a certain kind of business. On the other hand, what do I call as non-business risk? Non-business risk is the risks arising from the fact that I'm doing business. Now, if I did not do the business, these risks would not have arisen. For example, if I want to do a business, I don't have money. How do I do the business? How do I start a business if I don't have money? What is my next best alternative? What will you do if I don't have money and I still want to do business? How will I do the business? How do you think I'll do the business? Borrow money, absolutely. Absolutely. You'll borrow money. You'll borrow money from the bank. You'll borrow money from friends, family, whatever. So you're absolutely, you're right. We'll borrow money. Now, if I did not borrow money, okay, if I borrow money, what can happen? If I borrow money, I can have a problem that I may not be able to pay back, and therefore I can default. Now think of it. If I did not start the business, I wouldn't have borrowed the money, and therefore the problem of me defaulting would not have come up. The fact that the default argument is coming up is because I have had to borrow money, which is only because I wanted to do the business. So therefore, that's what I say. That's what I mean by non-business risk, or in some sense, risks arising from the fact that I've decided to do the business. Business risk, on the other hand, is essentially the point about, will I do the business? And if I do the business, what kind of business do I do? So, if I do, or a possibility of doing business, that risk is what I'm covering under business risk. Because I'm doing business, that will lead me to a certain expected loss, a certain kind of exposures. And those risks are what I term as the non-business risk. Right? So let's start with the business risk. Now, when you talk about a business risk, what's the first thing? What business will you do? What product will you manufacture? Right? What kind of a product will you manufacture? What product will you manufacture? You might want to manufacture a product which is already a success in the market. It is selling in the market. Very good. But just because you are manufacturing a product which is already selling in the market, does it mean that that will also be a success in the market? So let's think of it. Let's say, you want to manufacture another mobile phone in the market. Obviously, there is a demand for mobile phones in the market. You want to manufacture another mobile phone in the market. Very good. But just because you are manufacturing a new mobile, does it mean that the mobile will be successful? It may be. But maybe Apple will kill you. Maybe a Samsung will kill you, because they also in the business of manufacturing mobile phones. So while Samsung manufactures a certain kind of mobile phones, Apple manufactures a certain kind of mobile phones, you also want to manufacture a mobile phone. There is a huge market and everybody can survive. But that does not automatically mean that your product will survive, your product will do well. And that is a business risk that you take, because you have decided to manufacture a certain kind of mobile phone, or a certain kind of a product, and that becomes a challenge that you kind of have. And that's a risk that is there. The second is what I call as a macroeconomic risk. Now, what is a macroeconomic risk? Risks in the economy, risks in the larger ecosystem on which you do not have a control. Well, COVID is more, I won't treat COVID as a macroeconomic risk. I will treat COVID more as a disaster and an event risk. And I'll come back to that, and I'll come to that. But, a recession, an increase in interest rates, or a drop in interest rates, things like that, economic upheavals is essentially a macroeconomic risk. You cannot do anything to control the macroeconomic risk. You can take some action to control the impact of macroeconomic risk on you, but you cannot do anything to control the macroeconomic risk. For example, inflation is a problem, right? Can you do something by which you can control inflation? So I don't know what the inflation in Vietnam is. What is the current inflation in Vietnam? What is the current level of inflation in Vietnam? Somebody? What is the current level of inflation in Vietnam? Nobody? Okay, let me assume that the current level of Vietnam is, let's say, 6%. Can you do anything to the fact that the inflation rate is 6%? You cannot do anything to the fact that the inflation rate is 6%, right? What can you do? You can do some action. You can kind of do something such that you can invest in a certain manner and exactly such that the impact, you ideally want inflation to be, let's say, only 3%. The fact that it is at 6%, you cannot do anything. What can you, as I said, what can you do? You can take action such that the impact of this 6% is not felt by you. You do not feel the impact of 6% on you. You know that the demand is, so the inflation is still 6%, but you have done something to ensure that your impact is not more than the 3% which was acceptable to you. It's something like temperature. You cannot control the temperature, whether it is too hot or too cold. What can you do? You can do things, you can take action such that you are protected or you are covered against that. So if it is too cold, you can't control the outside temperature to become hot suddenly. You don't have a control over that. You can wear an extra jacket, you can wear a cap or gloves or whatever, a pair of gloves or whatever, to ensure that the impact of cold is not felt on you. Or if the outside temperature is too hot, you can make sure that the air conditioning, the aircon is switched on at a lower, at a higher level. The cooling is set at a higher level, such that you can the impact of the impact of the heat is not felt by you. But you cannot do anything beyond that. When you think of these kinds of things in the economic context, in the macroeconomic context, and therefore the uncertainty that kind of gets created because of that, that is what is called as a macroeconomic risk. These risks are something on which you do not have any control. Some risks you can take cover against, not all, and therefore these are risks that you will actually have to deal with. And finally, you have technology risk. Right? You have a technology risk. And what is a technology risk? The technology risk part of the story is that, as I said, you want to start building, you want to set up a mobile handset manufacturing plant. The problem is, the plant will take 3 years to get set up, and the first mobile phone that you will make will come in after 4 years or after 5 years. What technology will you use? Will you use today's technology, or will you use a different technology? It will be easy to use today's technology, but what is the likelihood that a phone based on today's technology will be relevant, will be useful, will be something which people will buy after 5 years? Chances are that is very, very low. Which means, therefore, you have to select a new technology. The moment you go into selecting a new technology, that becomes uncertain. Because you think a certain technology will work, you think a certain technology is useful to be used. However, maybe the world, maybe the market will have a different technology that they want to kind of use. And even if you make a right choice today, it is no guarantee that this choice will be correct going forward after 5 years. In fact, most of you would not even have heard of it. But in the late 90s and early 2000s, when mobile phones became as popular as it is today, there were two competing technologies in the world that mobile phones worked on. The standard GSM technology that we all use, or there was another technology which was basically what was the other one? The one that this guy's I'm just forgetting the name. So there was another technology that was kind of propounded and tried to be popularized by some of these mobile companies. USA. So while the rest of the world ran on GSM, USA and Japan for some reason ran on the other technology. That technology was supposedly better than GSM. However, And in those days, USA was the largest market. Japan was a very large market. So one would have expected that the technology would move in that direction. However, for some very strange reason, that technology was never really became popular, and GSM became the popular laptop, the popular technology on which the phones are used, and we use phones today, as we know. Now, if you were in the early 2000s, and if you were setting up a plant, and if you were setting up a plant for the other technology, things would have been looking good for you, because that is the two largest markets in the world. CDMA, you're right, CDMA, thank you very much. CDMA was the alternate technology. Now, if you were setting up a CDMA based plant, it was a very good, it would seemingly look like a very good decision, because CDMA was being used by the US market, by the Japanese market, by the largest markets in the world. However, 5 years later, as it turned out, CDMA became a useless technology. I mean, for whatever reason, GSM became the most prominent technology, and CDMA kind of vanished from the scene. Now, look at what would have happened if you had set up a plant. You would have lost your money, and that's a risk that you were kind of running, and that's a business risk, because you chose to kind of do a CDMA technology. You chose to use a CDMA technology over the GSM technology. Now, you obviously had very valid and very good reasons as to why you chose the CDMA technology. But this is how markets work, and that's kind of a risk that you would obviously run, and that is a risk that you have obviously run. So that is kind of so technology risk is not just about using the correct technology today. Technology risk is also about being able to spot and choose the right technology for the future. Technology risk is also about choosing the right technology, not as I'm repeating, not for today, but making the appropriate choice of a technology for the future, which is a very, very difficult proposition, which is something which is very difficult to kind of do. How do you choose the right technology for the future? Choosing the right technology for today itself is difficult. How do you choose the right technology for the future? And then that is one of the biggest risks that business risks kind of take. So and then there are many more. This is not the only one. These are the key ones that I just wanted to highlight, and show you that kind of a scenario for you. Okay, let's do one thing. We'll do the non-business risk and the rest of the slides also. But I think we can take a break. So we've been doing it for over an hour, close to 2 hours, 1 hour 40 minutes at a stretch. So let's take a break for about 15 minutes. So it's about what? It's what 8:50 for you, right? About 8:50 p.m. for you. So let's join back. So let's take a break. Let's join back at 9:05, 15 minutes. Let's take a 15-minute break and let's join back at 9:05. Is it okay? Okay. And meanwhile, if you guys have any questions, I'm here. Feel free to ask me, or we'll take a 15-minute break and we'll join back at 9:05. Okay. Let me put this on pause recording. Okay. So, as I said, we have this non-business business risk side. Let's look at the other side of the non-business risk, and that's the part that I want to complete today. This set, so that from tomorrow I can start off with the other bits. Now, in the non-business risk, I've divided it deliberately into two parts: event risk and financial risk. And we will look at what we've done. So what are we saying in terms of event risk? Event risk is what we define as risks which arise, which kind of happens. So there is some regularity with which this happens. It is not as if it does not. But there is no frequency. So I cannot say it will happen. It will happen every month. It will happen every year. It will happen every 5 years or something like that. But at the same time, I know it will happen. So if it happens today, I don't know when the next will happen, but I am certain, it will kind of happen. There will be a regularity with which it will happen, but when will it happen? I do not know. And that is a challenge that typically these event risk issues kind of have. Under that, what do you have? You have legal risk, we have reputational risk, disaster risk, and you have political or regulatory risk. Now let's look at one at a time. So for example, let's look at disaster risk. Now every now and then some disasters happen, some real challenges happen, and that does lead to a problem in the business. That does lead to problems in the whole overall scheme of things. So that does happen. However, do we know when the next when disaster will happen, and how long will a disaster last? So for example, we will all agree COVID-19 is a problem. COVID-19 has created a real problem in the system and is kind of created a lot of risks, and in some cases you could argue it's probably even translated into losses. But we do not know whether the cycle is over, whether that's all the losses that will be there, or there are more losses to come up. We are yet to kind of understand that, and therefore to that extent there is a lot of losses that COVID-19 is kind of coming up, and it is a disaster that has happened for certain. When will the next disaster happen? Do we have any idea? And the answer is no. We know for certain some disaster or the other will happen, but we do not know when the next disaster will happen. What form the next disaster will take, we do not know. We cannot protect ourselves against all future disasters, and therefore we are going to be exposed to disaster risk. But we do not. And therefore there's very little that we can do. I mean, we can take some precaution. We can take precaution against existing disasters and existing experience of disasters, but beyond that, we cannot do much about it. Right? So that's what I kind of want to highlight through disaster risk. Legal risk. Well, there are a lot of legal risks that keep on happening. You enter into a thing, and then there is a legal case that happens. So all these business deals that, let's say, there's antitrust deals that happen, unfair trade practices deals that happen, and then the court rules in a certain manner in favor of one party or the obviously it has to rule in favor of one party or the other, and that could give rise to some kind of legal problems that gives rise to some kind of legal issues, and therefore you have legal risks that come in. A lot of these are also interlinked. So for example, there is this case in Germany that has happened, which is about Volkswagen. Volkswagen had a problem a few years back, which they tried to resolve, and there is still a court case going on, which is their emission data that they submitted for certain class of their cars was found to be false, and Volkswagen had to call back a huge number of their cars, do modifications to the car, and do a lot of those stuff. At the same time, people filed. And one would expect that, is that a resolution to the problem? Well, from a problem perspective, that might be a resolution to that problem. But then there was a set of people who went and filed a case against Volkswagen for falsifying data, for harming them, and all kinds of things. And that case is still going on. We do not know which way that might get resolved. And if that case gets resolved in favor of the people who have filed it, which is against Volkswagen, you see there is a huge potential payout and a compensation that might have to be paid, which will mean that Volkswagen will suffer a huge loss in the process. So these are kind of legal risks that happen. These are kind of things that sometimes you miss a certain point. I mean, in a large business deal, it's unlikely to happen, but in a small deal, sometimes you miss a small point, and something happens, and then somebody else observes that point and files and says, okay, no, legally this was valid, because you see there is this subclause out here which you have not seen, and stuff like that. So that all these kinds of risks do appear and do exist. Disaster I talked about. Reputation. Now this Volkswagen is also a case of also gets into a reputation risk argument, because one is what they have done. But the fact that they falsified data for whatever reason and tried to kind of sell that off in the market and stuff like that does lead them to this possibility that, what is the chance that they will do it once again? And if they do it once again, what is the implication of that? So there is a whole reputation loss that companies and entities will suffer because of these kinds of decisions that have been taken. And in that context, therefore, how does it affect the standing? How does it affect the process in the future? That becomes another question that one needs to kind of address or ask or address and then look at that. And that's a challenge that you have in the whole process. The last one in that, and again, not just the last one, but in that list as we have it out there, is this argument of political or regulatory risk. Now, what is this? So, this happened in Malaysia. In Malaysia, this has happened many times, but it happened in Malaysia about 2-3 years back. So Malaysia, a few years back, changed their whole tax structure, corporate tax structure, indirect tax structure, from sales tax to what they called as, or from sales tax and value-added tax, VAT, to what they called as GST, goods and services tax. Now, the goods and services tax, for whatever reason in Malaysia, was very unpopular, and the previous government pushed it through. One of the main election manifestos on which the current Prime Minister Mahathir fought the last election was abolition of the GST. And it just so happened that Mahathir won the election, and his very first action as Prime Minister of this term was that he cancelled the whole GST system and said we will go back to the old VAT system, sales tax stroke VAT system. Now, on the face of it, you might argue, what's the big deal about it? The problem with this is, you see, there is this whole system for a certain period of time which has worked towards converting their whole system and all processes to be GST compliant. Suddenly, one fine morning, because there is a change in government, because there is a change in a regime, somebody comes in and says, oh, no, I don't like this, so therefore it will be the old system or it will be a new system. The cost of transfer, the cost of doing it once again is very high, and therefore, how do you kind of account for that? And then what are the costs that would come in is a question that one has to kind of answer, and that becomes a risk. There's a big problem with these kinds of risks, and the problem with this kind of risk is, how do I quantify this? Both this and the business risks. I'll come to financial risks in a second. How do I quantify this? It is very easy to define and talk about some of these risks. But how do I quantify this risk is the question. And that is not possible per se. That becomes very difficult to do. It is very difficult to quantify these risks. And therefore, in a sense, while these risks happen, one of the primary arguments in risk management is to identify and measure the risk, as I said, and that measurement becomes a challenge. Which is also one of the reasons as to why we try to kind of focus our attention primarily to the argument of financial risk. Financial risk, by the way, is not the only risk, as we can see. But what is financial risk in this context? These are risks which lead to direct financial losses. It is not that the other risks will not lead you to losses. They will also lead you to losses. Losses at the end of the day are all financial. Whether it is because of legal or reputation or product or technology, the loss that you incur is still direct financial loss. You lose money or you do not earn money, and therefore there's a direct loss financially. The question is, how do I measure this? And the segregation that is done is in financial risk, this is something which can be at least measured in some objective manner. Using a model, using a formula, using an approach, you can objectively measure it. You can take some action towards controlling for it. You cannot do that in the other sets, and that is what differentiates financial risk from these kinds of risks in the process. Now, financial risk is divided into these 4 categories. Some people argue it's divided into 3 categories. So some people do not look at liquidity as a separate risk bucket. They look at liquidity as a part of market risk. What is the definition? The definition of the distinction is market risk. So if I go with that order, and it is not in any particular order, market risk is the risks arising out of factors over which you do not have any control. So things like price rise, inflation, exchange rate, you cannot control it. You cannot define what the dollar, Vietnam dong, VND, USD rate will be. That is decided by the market. That is kind of defined in a different context. You cannot define what the inflation rate will be. This is kind of defined by a lot of other factors. But the change in these rates could potentially have an adverse impact on you. So think of it, if you are an importer, you cannot control the dollar rate. But if the dollar becomes more expensive, which is the VND becomes cheaper, VND depreciates, your cost goes up, because as an importer, you will actually have to pay more. If you are an exporter, it's good for you. But if you're an importer, it's bad for you. Similarly, if the VND appreciates and the dollar depreciates, it's good for you as an importer, it is bad for you as an exporter. So it depends on what is it that you're trying to do. And then, you will be exposed to it. You cannot control, you cannot prevent it. You can control it. And that is all that market risk is all about. The next one is credit risk. What is credit risk? Credit risk is nothing but the risk of default. The risk of default if you've borrowed. What does it mean? That I have borrowed money and I do not pay back. And when I say I do not pay back, I am including the fact I do not pay back in full and I do not pay back on time. Because suppose I have borrowed for 5 years and I'm supposed to pay back monthly. I am supposed to, like a loan in EMI, I'm supposed to pay a monthly installment for the next 5 years. Now, I do not pay for the next 4 years. And for the next 4 years, 11 months. And then in the 5 years, I go and pay everything back together. That is also a default. In the old system, in the simple definition, one might argue that is not a default. We have actually paid back the money. So why are we calling it as a default? Well, the fact is that I've not paid back in time, and hence it is also a default. So today the definition of default includes not just non-repayment, but not non-repayment in time. I think that is also important in the argument of a default. What is liquidity risk? As I said, some people define liquidity risk as a part of their market risk. Some people define it separately, and I will leave it for you to decide where do you want to put it. But let me kind of explain what liquidity risk is. Liquidity risk is the risk that arises from the fact that it is not credit risk. It is not a risk of default, but it is an inability to pay because you do not have liquidity. So let's say you borrow money for 10 years and invest the money for 10 years in an asset which will give you a positive return, which will give you an acceptable positive return after 10 years. You are very happy with that. The person who has now lent you the money after 2 years comes and says, you know what, I am in desperate situation. Please give me back my money. Do you have assets? The answer is yes, you have. But the assets are not liquid because the assets will only give you money after 10 years. And there are still 8 years to go. So today you have a problem that you have assets which will mature and will give you money after 8 years. The assets have not defaulted, but you do not have the liquidity today to pay back the loan. And that is what is kind of called as a liquidity risk. I'll give you another example. All of you are working, or majority of you are working, right? I mean, I know a few of you may not be working, full-time students, but majority of you are working. So your employer tells you that, look, you know what? I'll give you a choice. You have your current salary. You can take your current salary every month like a normal thing. An alternate mechanism is, do not take your salary for the next 1 year. So I have paid you salary up to December. Do not take the salary from January 2022 to December 2022. You'll not lose. If you do not take this money for 1 year, I will add the total amount of money that you are supposed to get for this 1 year and double it. And in January 2023, I will give you double the money. But I will not give you any money for the next 1 year. The entire money plus the additional amount, which is double the amount that you're supposed to get, you will get in January 2023. Is that a good idea? On the face of it, you are getting double your income. So it might not be a bad idea. But then you'll have to look at it and say, how do I survive for the next 1 year? Do I have enough savings? Can I borrow? Can I go to my parents? Can I go to my family and ask for money and ask them to help me survive for the next 1 year, such that I get more money at the end of it? If all of that works for you, then yes, that is a good idea. However, if they do not, and you say that, look, I do not have the means to survive for the next 1 year, then even though you might be given a better option, you might be given more money at the end of 1 year, how will you survive the 1 year? And therefore, you will not be able to take that. So while it might still be profitable for you, liquidity will prevent you, or liquidity crisis will prevent you from taking that deal. And hence, it will not be a worthwhile deal for you. So it depends on the kind of structure that you will work in, and liquidity could kind of create a real problem. Liquidity is not, so importantly understand, liquidity is not about the fact that you do not have money. Liquidity is about the fact that you do not have liquid cash or amount in the way you need to spend it at the point in time you need to spend it. So liquidity is not just about not having money, but also not having the money in the form that you need at that point in time. Finally, you have what is called as operations risk or operational risk. And because I have something in the financial risk called operational risk, that's precisely why I did not write the non-business risk. I use the title non-business risk. I did not use it as an operations risk, though these are risks arising out of operating the business. Now, what is operational risk? Operational risk actually has no formal definition. There is really no clear definition of operational risk like market risk, credit risk, and all that. Operational risk is defined as the risks arising out of actions which have been caused by human systems, transaction failures. In other words, something which the another way of looking at it is something which cannot be classified as market, credit, liquidity, and all of these kinds of risks can be classified as operational risk. So I'll give you an example of an operational risk. So and this has happened. This has happened many times, but this can happen. And some of you are bankers, right? So if I give you when you transfer money, the bank system will have to transfer the amount from my account to your account. Now, let's say there is a slight problem in the system, and for some reason, the money that so I put in a transfer request of let's say $50,000. So I have to pay you $50,000, right? So so it should be 50,000 means what? 50, 100,000, 10,000. 5 and 4 zeros. So I write it as 5, 5, then 4 zeros followed by ... 0, 0. After, so no value after the decimal. Somebody by mistake misses the decimal point and inputs it as 50,000, 500,000, 5 million, and therefore inputs at $5 million. And here is the even bigger problem. See, if we try, my account may not have $5 million. So if he puts $5 million debit to my account, it will show up immediately and he may correct it. Let's say the mistake is he debits $50,000 from my account, but by mistake credits $5 million to your account. What happens? There is a loss that the bank will suffer, because after all, out of the $5 million, only $50,000 has been accounted for from my account, which means $4,950,000 will not be accounted for. That is the loss that the bank has to pay, or the bank has to bear, and then that could be a huge problem. In fact, as we speak, I don't know if any one of you have tracked this or have followed this. There is a bank in England, in the United Kingdom, and actually all across Europe. This is a Spanish bank called Santander, Santander. Over Christmas, Santander had a problem with their systems. And for a certain amount, certain kind of payments, those people who were supposed to get the payments actually ended up getting double the payment. So instead of one transaction, Santander's systems landed up making two transactions. So even if I asked you to make one payment, the system made two payments. One payment was debited from my account. The other payment was obviously not debited from my account, and it was debited, but the money was still paid. So who paid for this money? Santander so effectively this money has gone out of Santander's own reserves. And the loss is to the tune of about 175 million pounds. In the last 2 weeks since they found this out, or 2 or 3 weeks since they found this out, they found it out immediately, very soon after the whole issue. But the problem was this money was transferred. And then these transfers are not to other accounts in Santander. This could be in people having accounts with Barclays, with NatWest, with Credit Suisse, with BNP Paribas, whatever other banks you can think of in Europe. Santander has actually now, over the last 2.5 weeks, been very closely trying to work with all the other banks in Europe to identify where such errors happened and to withdraw and to kind of get into a mechanism by which they can try to reverse or retrieve most of this money. We don't know what the legal implications would be and would they be able to do it or not. But as we speak, this has happened, and this is a huge operational risk failure that has happened, which has resulted in something like, as I said, a potential loss of about 175 million pounds is what Santander is currently, exposed to. Now, these are risks that will keep on happening. These are factors that will keep on happening every now and then. And can you do something about it? The answer is very little. You can protect your systems. You can have better monitoring mechanisms and things like that. That's what everybody does. But remember that this also comes at a cost. So you can't have an absolutely foolproof protection system that takes care of everything. You can only reduce the likelihood of such an event happening, and you can therefore reduce the likelihood of the potential loss. But beyond that, you cannot do much about it. What is this? So moving on from that table, or from that broad chart, which is a very broad identification, what I've done out here is I have listed out, again, this is not an exhaustive list, but you can see this list is far more detailed, far more granular, and has a much more detail, much more the total. What I mean is a bigger list, a much larger list of the risks that can be there in the system. Now, is it true that all the risks will hit you at all points in time? Not necessarily. It is not that all risks will hit you at all points in time. But these are the possibilities that can kind of happen. These are the possibilities of the risks that kind of exist in the system. And also, please remember, this by no means is just one risk. This is I mean, sorry, this by no means is the only set of risks, because this is as a better estimate or a better thing about the set of risks. But this list keeps on increasing. Some already exist, which obviously it's an infinite list, so it's not possible for me to put it in. And some which are newer factors which keep on happening every now and then, and therefore the list keeps on increasing. So both possibilities kind of exist in there. Okay. This is again the same problem. So what happens is, in terms of credit rating, so I was trying to kind of show you, it is here. I was kind of trying to show you the fact that, there are these two things called Moody's, and the two main rating agencies, Moody's and S&P, Standard and Poor's. Moody's is one, and the Standard and Poor and Fitch. So they have divided their ratings. So Standard and Poor divides it in terms of Moody's and Standard and Poor and Fitch divides it in AAA, AA, and so on. So there is a set of bonds which have the highest rating, which have the least likelihood of default. I'm not saying it will not default, but I'm saying it's got the least likelihood of default, and that is what is called as investment grade bonds. What does it mean? It means that investment in these bonds is relatively safe and will have lesser probability of a default. It is not that it will not default, but just that the probability of default will be lower. That is all that is kind of highlighting. The non-investment grade bonds are bonds which have a higher probability of default. Again, it does not mean that it will not it will default. In as much as the investment grade bonds does not mean that they will not default. Non-investment grade bonds do not imply that they will necessarily default. What they mean is that the probability of their default is higher compared to investment grade bonds, and therefore a lot of people might not want to invest in non-investment grade bonds simply because their likelihood of default can go up, and that is what they want to kind of avoid. They don't want to lose money, and that kind of reduces the possibility of them losing money. Now, these are some subdivisions, and that is not what my argument at this point is. Moody's divides it into every category. For example, AA category into AA1, AA2, AA3, whereas Fitch divides it into AA plus, AA, and AA minus. So essentially, they each have a large AA, and under AA you could have a AA plus. You can further subdivide into AA plus, AA, and AA minus, and so on and so forth. They divide all the categories in a similar manner, except AAA and the two last categories, which is default and C. Except AAA and C and D, everything else is subdivided into the three bits AA plus, AA minus, or AA1, AA2, AA3. That's just a notation. Now, what is the broad approach to risk management that is kind of talked about? The broad approach to risk management that is talked about is, one, it is risk aggregation. What does it mean? It basically means that individually people would, or banks or systems would want to get rid of the non-systematic risks through diversification. So instead of just investing in one asset, or instead of investing in just one kind of a place, one entity, it tries to invest or tries to diversify this into multiple assets, and therefore the more diversified you make it, there is obviously a reduction in the risk, and that is what it kind of reduces the non-systematic risk. It cannot, please remember, it does not, and it is not designed to reduce the systematic risk. The systematic risk is the risk of the entity, a risk of the entity, a risk of the market surviving. That is not diversifiable, that is not reduced, that cannot be reduced in any manner. That the only way that can be reduced is by putting in better systems in place, by having better processes and things like that. It is not the unique, what you can reduce is the unique risk in the market. There's also the second argument of risk decomposition, which is basically you do not target all risks together. You classify, or you identify which is a higher risk and which is a lower risk, relative in a given scenario, which is of more important and which is less important, and therefore divide it in that fashion and then target it in that manner. In practice, both individuals and banks use both approaches. Banks and any other organization, people use, though there are these two approaches, people use both the approaches. It is not that they use just any one of the approaches. They use a combination of both approaches. Okay, just before this slide, I also want to highlight one more thing. Therefore, following on from the previous slide, one of the things that you therefore realize is risk management is therefore, strictly speaking, not risk reduction, not what one would call as an absolute risk reduction. It is about risk redistribution. I have a high risk, you have a low risk, I diversify. Or what do you mean? I kind of pass some of my risk on to you. Why do you take my risk? Why do you take my position? The reason you are ready to take my position is because you believe and you don't think it is as risky as I think it to be. And therefore, there is a risk redistribution that is happening. It is not that I am doing something which will inherently reduce the impact of risk. This is not reducing the overall impact of the risk. This is redistribution, which is basically I am reducing the impact of risk on me. What will it happen? The overall risk in the system will still remain the same. The only way the overall systemic risk will go down is if the systems are improved. If you have better processes and better management in place in that context, not in an individual asset context. This then therefore brings us to the basic question that we said. And remember, one of the things I said was identification. What are the processes? Identify, measure, monitor, and finally control. What do you do with it? So this is what kind of brings me to that argument. The first argument is to kind of identify the risk. What is the source of the risk? That kind of identifies what kind of risk is it. Remember that even though we are dealing with financial risk, and even though we are kind of dealing with those four broad parameters of financial risk, which is market risk, credit risk, liquidity risk, operational risk, each risk is different in the way it manifests itself and the way it kind of acts and impacts people. And therefore, the solution or the resolution of those are also different and has to be done in a different manner. So therefore, I need to therefore be able to identify the source of risk. I need to be able to identify the source of risk, because once I identify the source of risk, only then I can think about how to address it and how to kind of solve that problem. I will not be able to resolve that problem if I do not know the source of the risk. Right? So therefore, I first need to identify the sources of risk, and I will define the sources of risk. I've already defined the sources of risk. I have market risk, I have credit risk, I have operational risk, I can also have liquidity risk. So it's important for me to identify the source of risk, because only on identification of the source of risk will I then be able to apply the appropriate resolution mechanism for that kind of risk. The next, and this, by the way, this is kind of something which this and the next one is kind of something very relevant and important, and is something which you must appreciate in a sense. Question is, what do I measure? So think of it. If I have a portfolio, of assets. I could have only one asset in my portfolio, in which case life is simple. I have only one asset in the portfolio. I simply manage I simply measure the risk of that asset, multiply it by the amount of money I've invested. That becomes the risk of my portfolio. So it is like, if I have only one. So if I've only invested in, as I said in the beginning of the session, I've only invested in Vietnam Airlines. Now so therefore now I want to find out the risk of investing in Vietnam Airlines. Vietnam Airlines I find out the risk of investing in Vietnam Airlines, multiplied by the amount of money I have invested. That gives me a measure of the total risk of investing in Vietnam, risk of investing from my perspective in that scenario. That is easy. But now, instead of investing only in Vietnam Airlines, let's say I've invested in 5 different assets. Vietnam Airlines, let's say Vietcom Bank, let's say a coffee company, one of your major coffee companies, one of your rubber companies, and let's say in one of the real estate property development companies. So I have 5 assets in which I've invested. I have airlines, I have a bank, I have coffee, I have rubber, and I have real estate. I now want to find out the risk of the portfolio. Now I want to find out the risk of the portfolio that I have. What do I measure? I can go and measure individually. I can measure the risk of the airline. I can measure the risk of the bank, investing in the bank, coffee, rubber, and real estate, and add them up. And therefore, I can add them up in the same proportion that I have invested in, and that will give me one estimate of the risk. Please understand that will give me one estimate of the risk. But that estimate of risk is one. It's okay, keep that. The other is I treat the whole portfolio as a single entity. So while all of this is there, I don't look at it individually. I look at the whole portfolio and use some method. There are approaches by which I find out the risk of the entire portfolio. And then now the point is what I can show, and this can be shown from statistical analysis, that the standard deviation, risk is measured by standard deviation. The standard deviation of the entire portfolio will be less than or equal to the standard deviation, the sum of the individual standard deviations of the components that make up the portfolio. So the risk, so basically what that means is the risk of the portfolio will be less than or equal to the risk of the individual components, sum of the risk of the individual components of the portfolio. What is the interpretation of, what is the implication of this? Now realize, and that comes in from the next part, and before we go there, but let me highlight this. If there is a certain amount of risk that you've measured, the next question is, what do you do with this? Is this acceptable risk to you? Is this not acceptable risk to you? If it is acceptable risk to you, fine. If it is not, you will have to take some action. Diversify, buy protection. Buy insurance may be a protection, but buy protection and things like that. Buy anything that you do is essentially a diversification argument. The point is, because you're diversifying, how much will you diversify? You will diversify to control for your risk. Now, if your estimate of risk is actually higher than what is the true value, you will end up doing more than what you need. So it's like this. You have invited 10 friends home for dinner. You need to order for food. But you've forgotten, but by mistake or for whatever, 2 or 3 of the friends, let's say, told you that we are going to come, but we would not have dinner because we have some other engagement, but we will still come and spend some time and have a drink with you. You've forgotten that. And now you want to order food. So you order food for all 10 people. What has happened? You've ordered more food, you've ordered extra food. You did not need that amount of food, but you've unnecessarily ordered that amount of food, which basically means you have spent more resources than you needed. So ideally, you would not want to do that. Ideally, you would want to order appropriate amount of food so that there is no wastage of resources. Same thing out here. Ideally you would want to manage your risk to the actual amount and not a higher amount. Having said this, and this is where the dilemma is, measuring the risk of the portfolio, measuring the standard deviation of the portfolio may not always be a simple approach, because there are challenges and the correlations and all that come in. That does make it a bit complicated. On that hand, in that context, measuring the risk of individuals is actually much easier, and adding it up is kind of relatively simple. So the question that you will actually have to answer is, do you go the hard way and get the appropriately, absolutely correct estimate, or do you take a relatively easier approach, approximate, but an overestimate? A lot of risk managers will say, we will go the the approximate way. We don't mind estimating it a little more, because what has happened is we are taking extra precaution and therefore we are extra safe. But a larger question you have to answer is, do you need to be extra safe? Do you have to be extra safe is the question. There is nothing. So the absolutely correct answer is to say you should only measure the portfolio. But there are challenges, there is difficulty. It is not always straightforward to measure the risk of the portfolio, and hence sometimes you may actually have to do it the other way, keeping in mind the fact that this is still approximate. And that is what is a question that you will have to take a call on. The third point is, what do you measure? Right? Or sorry, how do you measure? And this is important and this is relevant because the normal expectation is I will use standard deviation to measure. The problem is, if there is an outlier in the data, standard deviation will be significantly changed. And an outlier essentially means that this is not likely to happen in the future. You are using historical data, you are using past data to kind of predict the future, right? And then you are saying that this is not likely to happen in the future. Now, ideally, statistical theory would argue that you drop the outlier from the data and re-estimate, which is easy. But two problems can happen. One, if there is not a very large data set, if you drop data from your estimation set, the estimates may be subject to error. But the bigger problem is, I am saying it's an outlier and then drop it. How do I know it's an outlier? Looking back in history, today, for example, if you look at and see what happened in September 2001, 11th of September 2001, yes, the event was an anomaly, an outlier effect, and the resultant impact on the financial markets arising from that can be treated as an anomaly or an outlier. But as you are going through the process, as you are in the current scenario, just because there is a deviation from a large deviation in a given day does not automatically imply that I will be able to identify that this will be kind of automatically an outlier event, and therefore dropping an outlier, dropping an outlier is not a problem. Identifying the outlier becomes the biggest challenge, and because identifying the outlier becomes the biggest challenge, we cannot drop it. Hence, instead of using the standard deviation, another alternate way is to kind of look at a percentile based approach, where I say, okay, 95% of the cases are 95% of the times I am safe, I am below the limit. 99% of the times I am below the limit. I know 1% or 5% of the times I will breach the limit. And when I breach the limit, I am not talking by how much I am breaching the limit by. That is another way of looking at it, and that is another argument by which you can measure the risk of a security or a portfolio. Again, like in the context of what do you measure, how do you measure also becomes a question, and monitoring is essentially how do you measure. How do you measure also becomes an important question, and you need to be able to address that, and you need to be able to answer that in that fashion to be able to explain that if you think there are no outliers, normal standard deviation is a good approach. However, if there are outliers, then you will actually have to define it in that manner and control for it. Finally, the control mechanism. What do I do with the control mechanism? What we are saying is, now that I know how much is the risk, having followed whatever processes, I've identified what is the risk. What do I do next with it? What do I do next with it? If the risk is within acceptable limits, I do nothing. However, if the risk is beyond it, I will have to do something. I will have to diversify. I will have to sell down something. I might have to buy insurance protection. I might have to do something else. What I do is another question. But what happens is, that is what your supervision process is. That is what the action that you take to ensure that the risk is within the acceptable limits. And this is a dynamic, please also remember that this is a dynamic process. This is not something that you will do once and you will forget about it. This is a dynamic process, which means that I will actually have to keep on doing this on a regular basis, because market changes happen on a regular basis. So essentially this becomes a fairly dynamic process in the overall scheme of things. And therefore what I have today is not what is going to be relevant tomorrow. The markets will change, and therefore I will actually have to reallocate based on that, and I will actually have to restate in that position. So therefore I will actually have to readjust. I will actually have to rerun the process and look at this allocation, look at the supervision every time. The only thing that probably I will be able to not do every day and get away is, once I've identified the source, I may not have to re-identify the source, but I will have to do the measurement, because how much has the change been? I will have to monitor it, and I'll have to kind of run, how do I measure it? Well, I may have decided once that I can continue with that approach, be consistent, but I still have to run that process, and then I will have to run the process and decide whether I want to allocate, or whether I want to reduce it by diversification, whether I want to reduce it by adding on by buying an insurance contract. What is it that I want to do to kind of reduce the whole thing is something that I would need to do post that. Okay, so that is what the broad argument of risk management is all about. Now there are a few slides after this which I don't want, which is you can read what it talks about it. What are some of the key risks that can come in from each one of them? So I'll do something tomorrow when I start. I will kind of quickly talk about these few things, key risks. Let me not, because this will take at least 15-20 minutes to cover, and then I will move into derivatives. So there is a slide, there is a deck that you have called Introduction to Derivatives and Futures. That is what I will start off tomorrow, so you guys can have a look at those slides, because that will kind of then tell you, because that is what are the tools that I have to kind of address the risk issue. So I will spend a little time, because calculating the standard deviation is straightforward, all of you all know, so I don't really have to do that. But I will start with that argument, and I'll see as to how we can then address, and then the rest of it will be essentially on the derivatives part. For the rest of the 7 days, we will be talking about the different, after I finish this, we will be talking about the different kinds of derivatives, how can you address them, how can you price them, to look at how do you use that from a risk management perspective. Yeah, Winhomes and all of that is fine. That's fine. Okay. Okay. So let me stop with that today. The other thing also I will do tomorrow, I did not do today, and in fact, I'm sorry that I'm sorry that the whole confusion about the speakers happened. Today we finally figured out a solution, and I will kind of not play around with it. I will use this solution tomorrow also to kind of run the session, run the sessions every day in the same manner. What I'll also do tomorrow, at some point, when all of you guys are there, may not be right in the beginning, but a little later, maybe right after the break or just before the break, whenever, we'll spend a few minutes talking about evaluation of the course, right? Because there is a small project component, and then there is an end term component. So let's spend a few minutes making sure that we are all on board on this, all on the same plane in terms of the evaluation component for the course. Okay, is that fine? Good. Any questions for today? I am once again sorry for the problem that Canvas created, but as I understand, and as most of you have confirmed, the slides that I have already sent you, the deck that I have sent you already has the things in proper format. So therefore, please do refer to that. Any questions that you guys have, I will start off tomorrow first by addressing those questions, if at all any, and then only go on to the next, go on from there. Okay. 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 So let's wind up today. I mean, I know it's about 10 o'clock already for you all, quite late in the evening. So let's wind up. See you tomorrow.
Okay, guys, see you tomorrow. Bye.